All right, let's dive right into this. Welcome to this week's Explainer. If you've been watching the tickers lately, you know it feels like we're caught in this massive tug-of-war. On one side, we've got the deafening noise of geopolitical anxiety. And on the other side, the incredibly stubborn structural signals of fundamental growth, largely driven by the absolute unstoppable momentum of artificial intelligence. It's a classic battle between raw emotion and hard data. And today, we're going to figure out exactly who is winning that fight. Now, you might be wondering, what's the actual mood out there? Well, the Fear and Greed Index hits the nail right on the head. It's sitting at exactly 49, dead neutral. After weeks of these wild, unpredictable swings, the collective emotion driving the broader market has just settled right on the fence. It's a flawless snapshot of the current environment. Investors are caught squarely between deep global anxiety and this surprisingly persistent underlying market resilience. So, to make sense of all this chaos, we're going to break things down into 5 quick areas: equities, forex, commodities, crypto, and finally, the big picture. Okay, starting off with Section 1, equities, where AI is clearly leading the charge. Right now, it's pretty wild out there. Structural tech trends, and honestly a healthy dose of greed, are absolutely winning the day. Just look at the stark divergence we're seeing in the US indexes. The S&P 500, up 2.1% at 7,600 points. The Nasdaq Composite, surging by a massive 3.08% to hit 26,280. But then, there's the Dow Jones, which actually dropped 2.3% down to 52,765. And you know what's crazy? Despite the Dow dragging its feet, this is actually the S&P 500's 4th winning week out of the last 5. Capital is flowing for sure, but it's being super picky about where it lands.
So what's causing this massive split? Well, it basically comes down to what's inside these indexes. The tech-heavy Nasdaq is just on fire right now, relentlessly driven by AI. Nvidia and the broader semiconductor sector are basically the engines of the entire market right now, and that was totally supercharged by SK Hynix's massively successful IPO. Meanwhile, the Dow Jones is weighed down by industrial and defensive stocks. They're acting like a giant anchor. Investors are literally choosing the flashy promise of future tech growth over traditional blue-chip safety. Now, if we look across the Atlantic, it's a slightly different story. European markets are playing it super cautious after falling from their recent peaks. The STOXX Europe 600 is just hovering around 641.1. That's down about 3.1% from its high. The DAX and CAC 40, they're stuck in these painfully narrow trading ranges after dropping nearly 4%. And the FTSE 100 is just getting knocked around by all the volatility in oil prices. Capital hasn't completely packed up and left Europe, but traders are, they're sitting on their hands. There just isn't a strong enough catalyst to trigger a new uptrend there, so US markets are remaining the undisputed center of gravity.
Moving on to Section 2, forex, where the dollar strikes back. Okay, let's see how this builds, because this is where those macro realities and market fears are really playing out. 100.6, I want you to lock that number in your head. That was the absolute floor where the US dollar, the DXY index, staged a massive, massive recovery. For days, the dollar had been correcting downward, looking surprisingly weak, right? But then, 100.6 acted like a concrete trampoline, bouncing it aggressively back into play. And when you look at it, the bounce is just striking. A definitive upward trend locked in rapidly by week's end. The greenback, which, honestly, a lot of analysts prematurely thought was losing its edge, just came roaring back to life. It caught a ton of traders completely off guard and basically reset the whole currency landscape. So why the fierce comeback? Well, it boils down to 3 really potent forces. First off, the Federal Reserve is in absolutely no rush to ease monetary policy. They are keeping rates higher for longer, period. Second, there's this sudden massive demand for safe haven assets globally. And third, those ongoing unresolved geopolitical tensions, yeah, they are reliably funneling international capital straight into US cash. And actually, these exact same forces are what's keeping US bond yields so stubbornly high, which causes a huge ripple effect across other defensive assets, as we'll see in a second.
All right, Section 3, commodities. Let's talk about roller coaster oil and gold.
If you ever wanted to see what it looks like when global headlines dictate highly emotional price swings, well, here you go. The sheer volatility across crude oil and gold right now is staggering. It's the perfect illustration of a knee-jerk geopolitical reaction versus eventual market realization. You know the drill. Terrifying headlines hit, prices explode upward in pure panic, and then slowly, rationality sets in, people actually look at the data, and prices correct back down to the fundamentals. Take oil, for instance. We saw Brent and WTI prices briefly spike by a terrifying 12 to 13%, driven purely by fears escalating in the Middle East. But as the week went on, prices fell right back down below those peaks. Why? Because the market took a breath and realized that actual physical global supply chains were totally uninterrupted. The tankers were literally still moving. That massive spike was essentially just a quick, headline-driven bounce after a previous rapid drop. It just goes to show that, for now anyway, actual supply realities are outweighing supply fears. And then we have the whole gold conundrum. Gold is currently sitting at roughly $4,121 an ounce. It's had a surprisingly tough month, down about 2.2%, even though, to be fair, it's still up a super healthy 22.8% year over year. But here's the puzzle. Why isn't gold soaring to the moon during all this intense geopolitical stress? Well, it goes back to what we just talked about with Forex. The surging US dollar and those rising bond yields are acting like a heavy, wet blanket on non-yielding assets like gold. Despite the scary headlines, the actual safe haven cash flowing into gold is surprisingly limited. Basically, investors are choosing the high yield of the US dollar over the traditional safety of shiny metal.
Next up, Section 4, crypto, where Bitcoin recovers lost ground.
If we want to quickly gauge the broader market's true risk appetite, we just have to glance at Bitcoin. It managed to claw back its lost ground this week, bouncing impressively after testing a really deep, critical floor at 61,000 USD. Seeing that aggressive buy-the-dip action from both institutional and retail investors, that tells us risk appetite is absolutely improving. But make no mistake, the crypto market is still heavily tethered to whatever the US dollar is doing and whatever the Fed decides to do next.
Finally, Section 5, the big picture, and our market takeaways.
So, what does this all mean? How do we synthesize all this chaos? Well, if we zoom out, 3 main themes are coming through loud and clear. Number 1, AI dominance.
Despite all the global turbulence, tech and semiconductors are still a massive magnet for capital. Number 2, geopolitical restraint. Oil and gold prove that while traders are definitely reading the headlines, they're not pricing in worst-case apocalyptic scenarios. The reactions have been remarkably restrained. And number 3, the Fed returns. With the initial geopolitical panic kind of fading, the market is pivoting right back to macroeconomic fundamentals, mostly inflation data and interest rates. So right now, fundamental growth is definitely winning the tug of war against fear.
Which naturally leads us to the big question. What on earth is going to drive the market next week? The dust has settled a bit on this week's panic, but the road ahead is jam-packed with market-moving data.
You're going to want to watch these 3 catalysts super closely. First, U.S. inflation data, specifically the CPI release, that could instantly shift expectations around the Fed's next move. Second, corporate earnings are rolling in. Institutional money is going to be laser-focused on forward guidance from tech and AI to see if they can justify these sky-high valuations. And third, keep a vigilant eye on the Middle East, especially anything that tangibly threatens physical oil supply through major choke points like the Strait of Hormuz.
This tug-of-war is far from over, guys. With critical inflation data and massive AI earnings on a direct collision course with lingering global tensions, the real question is, are you prepared for the volatility ahead? Keep your eyes on the data, stay fiercely focused on those fundamentals, and we will see you on the next explainer.